In the last 1 year, the stock market has cheered investors. The most popular index, Nifty 50, is up 26%. The broader index, Nifty 500, is up by almost 40%. But one industry that is acting the exact opposite is the paints industry. Take a look at all the big companies and you would find them in red. Asian Paints is down by 13%, Berger Paints minus 10%, and so on. In fact, in the last 3 years, the biggest paint company, Asian Paints, has delivered zero returns, whereas NSE 500 is up 71% and Nifty 50 is up 36% in the same time period. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance and investments. In this video, we are going to give you a quick update on why paint stocks are in red while the overall market is in a good mood. Even better, we'll discuss the 5 most important things you should look at while evaluating paint stocks. Now, the reason for the meltdown in paint stocks is not 1, not 2, but 3. Number 1, volatility in crude prices. Key raw materials for paints come from crude oil. Geopolitical tensions in 2022 caused crude oil prices to spike, which had a direct impact on the profitability of the paint stocks. For instance, crude oil prices averaged $100 per barrel in 2022, up from $50 per barrel in 2021. This led to a decline in the earnings of the paint companies. Asian Paints and Berger Paints, the largest players in the sector, have seen earnings before interest, taxes and depreciation decline by up to 5 percentage points in the last 2 financial years. Now in 2024, crude oil prices is already up by over 12%, which has raised concerns among investors about profit growth in the paint companies. Number 2, widening volume-value gap. In financial year 24, paint companies saw a wide gap between the volume of goods sold and the revenue generated. Asian Paints reported 9% volume growth, but only 3% value growth. Similarly, Berger Paints had strong double-digit volume growth, but only 6% value growth. This indicates companies are focusing more on volume to retain market share than selling high-value products. The strategy is impacting the growth of profitability in most of the paint companies. Number 3, entry of big new players. New entrants like Grasim, JSW Paints and Pidilite have increased competition. Grasim's Birla Opus aims to reach 10,000 crore rupees in revenue within 3 years. On the other hand, JSW Paints has already crossed 2,000 crore rupees in financial year 24 and is aiming for 5,000 crore rupees revenue by financial year 26. This competition has forced existing companies to slash down the prices, thus putting pressure on the ability to improve their profits. So if you are considering betting on paint stocks, here are 5 things you must keep in mind while evaluating paint stocks. Number 1, understanding the Indian paint market. In India, the market is mainly driven by decorative paints, means the paint we have in our homes. And just a few big players dominate it. The top 5 companies, Asian Paints, Berger, AkzoNobel, Indigo and Kansai Nerolac, control 90% of the organized market. Now understand this. The paint sector is influenced by the economic cycles. If the economy is doing well, real estate sector is booming, consumer sentiments are positive, the paint industry will prosper and vice versa. So fundamentally, paint stocks are cyclical stocks. Mostly their performance depends on the well-being of the overall economy. Second is how the company is expanding its reach. Now this information is crucial as it tells you how aggressively the company is expanding its reach relative to competitors. For instance, what gives Asian Paints an edge over its competitors is its large distribution network. It has more than 160,000 retail touchpoints, which gives it strong brand recognition and the ability to innovate. 5 years back, the company had a network of just 60,000 dealers. So when you compare paint stocks, check how the company has expanded its distribution and retail network over the last couple of years. Now, since we have 2 new big players entering the market, you must also keep an eye on their expansion. For example, Grasim already has a presence in the paint industry through its putty business, Birla White. This gives Grasim direct access to the paint industry and will help it to expand faster. This is expected to hurt the existing players in the short term. Number 3, major source of revenue. Where the company is earning most of its revenue from is a crucial factor to understand. Now, for example, Asian Paints mainly focuses on decorative paints, which makes up about 90% of its revenue. Now, how will this information be useful? Well, In the current scenario, with Grasim and JSW Paints expanding into the decorative paints market, could significantly affect companies like Asian Paints that rely heavily on this segment for their revenue. Number 4. Compare the financials. Any paint stock you pick should showcase these three things. First, the company should have consistent revenue growth combined with profit growth over the past few years. This shows that the company is growing its profit by increasing sales and capturing new markets. Second, lower inventory days or higher inventory turnover ratio. This tells you how long on an average products sit in the warehouse before they are sold. Ideally, you want companies with lower inventory days and higher inventory turnover ratio. Third, return on capital employed (ROCE). This metric shows how well a company is using its capital. A higher ROCE means the company is making good returns on the capital. It has included both equity and debt. Coming to number 5, valuations. So if a stock is available at a price which is lower than its worth, it is known to be undervalued, and vice versa. The largest player in the paint industry, Asian Paints, is trading at a price to earnings PE ratio of 51, which is lower than its average 5-year PE of 75. Same goes for Berger Paints. So going by numbers, these stocks seem to be undervalued, but that should not be your only criteria to evaluate a paint stock. Every factor boils down to the profitability prospect of the company. So as we have seen, the paint industry is going through hiccups in terms of higher input costs, higher competition due to new entrants, and widening volume value gap. The undervaluation of stocks do not look appealing. And with this, we have come to the end of this video. Hope you found it useful. Please share it with your friends and colleagues, and we'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.